Well, let's jump into it. So for this week, we're going to talk about mortgage rates. Let me share my screen and see where I can put this thing. Share screen. Let me share this screen, and let me put this over here. Sorry, man. Just got to talk through it. I talk to myself a lot, so just.
Where's the headphones, man? I don't see the headphones.
Oh my gosh! Thanks for pointing that out, man. Hold on. Oh, here we go. But it's funny. I don't hear any feedback. Do you hear any feedback?
No feedback, man.
Here, let me do it because I want to be just like Darren. Hold on. Let's see, guys. Yeah, that gives me that pro look, doesn't it? Let's see.
Is that what it is?
I don't know. I feel a little naked without him now.
It's all about branding, man.
All right, there we go. Okay, so can you talk a little bit? Can you hear me?
No, I'm messing with you.
Bastard. All right. Well, look, so here we go. We're going to talk about mortgage rates rise above 4% for first time since December 2019. And this is from our friends at Inman.com. Inman.com is a real estate industry site. A lot of real estate agents use. So I will try to get this on the chat. You might be able to get in. I think they give you a couple freebies to check it out. So I'm just going to go ahead and post it. But let's get into it. So mortgage rates rise above 4% for first time since December 2019. FHA borrowers can expect to pay even higher rates, but lenders are offering discounts on jumbo mortgages too big for Fannie and Freddie, according to new Optimal Blue mortgage market data. So again, this is not only from Inman, but Optimal Blue mortgage market. The prospect of more severe Fed tightening has spooked bond market investors, pushing rates for conforming 30-year fixed rate mortgages above 4% for the first time since December 2019, according to a daily index of rate lock data compiled by Optimal Blue. The Optimal Blue mortgage market indices also show that while first-time buyers seeking FHA-backed mortgages can expect to pay even higher rates, lenders are offering discounted rates on jumbo loans that are too big for purchase by Fannie Mae and Freddie Mac. Do you want to unpack that a little bit, Darren, for some of us?
Sure, man. So, yeah, the 10-year rate is what is the biggest factor to determining mortgage rates. A lot of people will tie the Fed rate to the mortgage rates, but that's a shorter term rate. But the expectation of, the 10-year note and its value in the future has moved up pretty rapidly. Inflation is tied to that. And mortgage, we're talking about mortgage lenders giving breaks on their fees because their refinance business is falling off the table. Right. So the last data showed. So they're really hustling to try to get more business in, and they're willing to give discounts to do that. They have more control in the jumbo market than they do than the mortgage-backed securities that Fannie and Freddie will purchase. So that's why they're highlighting that component there.
All right. Optimal Blue's lock data shows rates on conforming 30-year fixed-rate mortgages eligible for purchase by Fannie and Freddie averaged 4.071% on Thursday. So that was last week, while lenders were offering jumbo loan borrowers rates averaging 3.696%. FHA borrowers, who are often first-time home buyers with lower credit scores and little savings for down payments, paid the highest rates, 4.122% on average. According to Optimal Blue's data, rates on the Workhorse 30-year conforming loan hit an all-time low of 2.77% on December 31, 2020, when the Federal Reserve was buying $120 billion in treasuries and mortgage-backed securities every month to support the economy during the pandemic. The Fed announced in November that it would begin tapering those purchases, a process that it will complete this month, setting the stage for policymakers to begin raising short-term interest rates in March. Fed policymakers have been telegraphing their intention to raise the short-term federal funds rate 6 times this year, 1/4 of a percentage point at a time. But bond investors were startled Thursday by a U.S. Department of Labor report showing the consumer price index rose 7.5% in January, the largest annual increase since 1982. Yikes. After that report came out, St. Louis Fed Chair James Bullard fueled investor concerns, telling Bloomberg News that he would support raising the federal funds rate by a full percentage point during the first half of the year, of rapid increase which would entail implementing the first half-point rate hike since 2000. I'd like to see 100 basis points in the bag by July 1, Bullard told Bloomberg. I was already more hawkish, but I have pulled up dramatically what I think the Federal Open Market Committee should do to fight inflation. Bullard also said he wants to begin shrinking the Fed's nearly $9 trillion balance sheet during the second quarter. Minutes from the committee's December meeting showed almost all members agree with Bullard that it would likely be appropriate to initiate balance sheet runoff at some point after the first increase in the target range for the federal funds rate. You want to unpack any of that? That's a lot of words. That's a big sentence.
Yeah, it is a lot of stuff. So first off, it's very interesting, and this has happened, multiple times over the last couple years, where it costs less money to borrow higher amounts.
More money.
So, right. The jumbo is, a much higher loan amount. And as it works down, the rates are increasing. So that's interesting. Usually people are trying to scoop in under a jumbo number. But for those of you out there, and many people in our market are getting jumbo loans, you might want to consider putting less down to get a lower rate. So at least understand where those numbers are, where the transition is, to determine what makes sense. Again, a conversation with a good lender who's aware of all this should be able to advise you on these components. And we'll backtrack and evaluate our client base and make sure they're following up on these details. So then as far as stopping buying the mortgage-backed securities, that, as they said, has been mentioned many times. The market knows it's coming. And what'll happen there is, rates will rise because it basically puts a little more risk to those who are holding them. The Fed isn't insuring all of these and just repurchasing them. So rates are expected to rise because of that, but also the market anticipates. So some of that is built in with them knowing it's coming. It's not going to all of a sudden change when it happens.
Yep. Okay. Thursday's inflation numbers and Bullard's reaction to them sent 10-year Treasury yields, barometer for mortgage rates, climbing 10 basis points Thursday, breaching the 2% threshold for the first time since the summer of 2019. All right, here we go. Impact of rising rates on home prices and sales. Fannie Mae's latest national housing survey showed the percentage of Americans who think it's a good time to buy a home fell to an all-time low in January, with rising home prices and interest rates making homes unaffordable for many would-be home buyers. In their most recent forecast, Fannie Mae economists predicted that many home buyers will be priced out of the market this year, and that sales of existing homes will fall 3.2% to 5.945 million. That would still be the second best year since 2006. And sales of new homes are projected to grow by 14.9% to 885,000 as builders start putting homes now under construction on the market. Fannie Mae economists expect that home price appreciation will remain strong, but decelerate in 2022 as worsening affordability will slow home price growth from a peak of 18.5% during the third quarter of 2021 to 7.6% by the end of the year. That forecast assumed that rates on 30-year fixed-rate loans would not rise above 3.5% this year, an assumption that now looks out of date. But rising rates could also supercharge the housing market ahead of the spring home buying season, as the fear of missing out on low rates could get buyers off the fence, according to a recent analysis by Mark Fleming, chief economist for First American Financial Corp. First American's analysis of the potential impact of rising rates shows that with rates at 4%, homebuyers already have 52,000 less in dollars, less housing buying power than they did in November. How interest rates impact home buying power. So there's the chart you guys can look at. It's pretty dramatic. Similarly, a recent analysis by Redfin estimates that when mortgage rates were at their all-time low of 2.71%, a buyer who could afford to make a $2,000 monthly payment, including mortgage, taxes, and insurance, could afford homes priced up to $425,250. With rates at 4.1%, the same buyer could not qualify for houses priced above $375,750, a difference of nearly $50,000. With home prices and mortgage rates increasing, we might start to see buyers trading space for smaller homes that are closer to amenities, said Kristen Lopez, a Redfin agent in Boise, Idaho. So instead of purchasing large homes in the suburbs, many buyers may settle for a smaller home or even a townhome closer to the city, and then buy a bigger house later if they need more room. Jumbo loans available at lower rates. Optimal Blue's lock data shows that while rates on conforming 30-year fixed rate mortgages eligible for purchase by Fannie and Freddie exceeded 4%, jumbo loans were available at better rates. Historically, that's not always been the case. During June, July, and August 2020, Optimal Blue data shows rates on jumbo mortgages averaged 3.29%, 26 basis points higher than the 3.03% average rate for conforming loans. Since then, the spread between jumbo and conforming loans has flipped and has been growing wider this year. During January, rates on jumbo mortgages averaged 3.39%, 27 basis points lower than the 3.66% rate for conforming loans. Thanks to rising home prices, Fannie and Freddie are now allowed to back single-family mortgages of up to nearly $1 million in some high-cost markets. Fannie and Freddie's 2022 baseline conforming loan limit was increased to $647,200 in most areas of the country, with a ceiling for one-unit properties in high-cost areas of $970,800. But Fannie and Freddie's federal regulator is requiring them to implement new fees on second homes and high-balance loans exceeding the baseline conforming limit. That means a growing number of home buyers may find that it's cheaper to do business with private lenders who fund loans without Fannie and Freddie's backing. Any comments from there?
No, I think, well, the one comment I'll say is that as the mortgage industry is impacted with lesser refinance or more difficult credit, pay attention. We will start seeing more product, meaning different options and different ways to verify income. And we might see some more spectrum of ranges with more limitations or higher fees. It might be an opportunity for, as they mentioned, private lenders to come in and offer, have a better position. And so the mortgage products will evolve over the next 6 months to a year, and they're already starting to happen now.
All right. Okay, mortgage rates by credit score and LTV. That's loan to value. So mortgage lenders are becoming more willing to loan to non-prime borrowers. There you go. With home loans provided to subprime and near prime borrowers up 17.6% during the third quarter of 2021, according to TransUnion. Since rates will vary by lender and the borrower's credit score and loan to value ratio, it's smart to get quotes from multiple lenders. While non-prime borrowers can expect to pay higher rates, Optimal Blue data shows that borrowers with excellent credit scores can obtain rates below 4% on conforming loans when making a down payment of at least 20% to keep the loan to value rate or ratio below 80%.
Right. So it's a time to pay attention, be aware, make sure, if you're getting a referral from an agent, it's a good source, and do a little shopping to see what products are out there. And what's coming to mind for me is 2002 to 2005, as the products just continued to ramp up to try to feed that industry, they just went off the rails. So
I was going to say, even with the new product this time around, it's not going to be like that.
Not off the rails. I think there's two things. Number one, there's some regulation in place that's going to limit it. Well, certainly Fannie and Freddie aren't going to buy that extreme product that they were just buying. And then people got burned. If that's too fresh of a wound for them to get that crazy, I hope at least. But be aware, understand, read the loan terms. Usually they're pretty basic, but in these times they might start getting more evolved.
Yeah. And, I just wanted to kind of end out on a comment that one of the real estate agents made to this. And it's, I think, very, very true. Note to buyers, don't let this information take you out of the market. Rates are still fantastic. You still have strong buying power when compared to what rates were like over the last course of 25 to 30 years.
Right. So the rates are still low. He's absolutely correct. The prices are high.
Right.
That's right. So, don't let the rate stop you from buying, for sure. I agree with that comment. But, yeah.
Okay. All right. Well, there you have it, guys. If you have any more questions about this, let us know. We're more than happy to talk about it with you.